Global markets are in a state of fear again, sending a strong vote of no confidence to policymakers in Europe. Problems arising from Europe's debt crisis flared up again as policymakers grapple with divisions, threaten bank downgrades and a Greek default. Here's Philip Lasker.
Investors throughout the region are having to swallow yet another dose of disaster from Europe.
Fear is actually starting to feed on itself, and that's not a good environment for businesses to make decisions in or investors.
Markets throughout Asia fell between 2% and 4%. Around 45 billion was wiped off Australia's All Ordinaries Index. Nothing was spared, with the big bank and resource stocks falling between 3% and 7%.
Whilst valuations for equities look very cheap, particularly in terms of dividend yields and the balance sheets that companies have at the moment, that fear is justified. I mean, we just don't know what's going on in Europe, and I think we're heading towards a crescendo where something needs to be sorted out. Something drastic may well happen.
Last week's resignation of a European Central Bank board member highlighted the divisions in Europe. Now there's speculation Germany is preparing for a Greek default.
Europe will be in recession for a long time, and that will affect the exporting countries in Asia.
And there are major concerns about the impact all this will have on the global financial system, with the credit ratings agencies expected to downgrade 3 big French banks, with many institutions in France and Germany holding Greek debt.
And that's going to take a whole host of capital out of the European banking system, which was already vulnerable.
Also vulnerable is the Eurozone and its currency, which is being dumped.
The euro has been a moribund currency really for some time now. And you cannot keep it in its current form with its current membership. I think it is a question of months, really, that we see the whole thing disintegrate.
Investors flock to the safety of AAA-rated Australian government bonds, sending the yield down 12 basis points. On the other hand, the cost of insuring Asia-Pacific corporate bonds from default rose to their highest level in more than 2 years. Australian banks were among those stocks which were hit hardest in today's equity sell-off.
Obviously that's feeding from fears in the banking sector in Europe. That's possibly overdone. But we do require some funding from those markets, and that's where the fear is.
Australian consumer debt levels are actually worse in Australia than they are in the US. We've got banks who have borrowed a lot of money from overseas, and we've got very jittery credit markets. So to say that we're not affected is actually wrong.
Financial problems have caused inevitable strains in the European family. Now some observers are waiting for the inevitable divorce after 12 years of marriage.
The problem is really that the interests are too diverse in Europe. On the one hand, you have Germany, for example, and Germany, of course, wants to keep its comparative advantage, namely the relatively subdued euro exchange rate, because that's boosting German exports. On the other hand, you have interests, of course, in the periphery countries, and they don't want to go through these austerity measures. They just want to take the rescue packages coming from the north and basically continue as usual. And you cannot get these two interests together.
And there'll be plenty of global pain in the search for a solution.